to everyone present here. May I request our respected dignitaries, Chairperson SIRC of ICA, CA Revati Raghunathan, Sanjeev Kumar Singhal, Chairman ASB, and to accompany the today's speaker, AKSHAY JALAN, CA Dr. Chinnsamy Ganesan, ROHIT AGRAWALA.
We can divide in this.
We commence the program by seeking divine blessings for a successful and insightful seminar, followed by the rendition of the ICI motto song. All of you to stand for the ICI motto song.
सुप्तेषु जागृति एष सुप्तेषु जागृति कामं 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 कामंशो पुरुषो निर्विमाणः तदेव शुक्रं तदेव शुक्रब्रह्मा तस्मिन् लोकः सर्वे तदूनात्यधिकश्चन एतद्वैता 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 एतद्वैता.
Thank you. We now invite the chairperson, SIRC of ICA, CA Revati Raghunathan, to deliver the welcome address and give introduction about the today's topic on importance of Ind AS 118.
Yeah. Very warm good evening to everyone here. I want to welcome our Central Council member Sanjeev Singhal sir, who has come all the way from Delhi, Chairman ASB of ICAI, and spearheading today's program. And three very eminent members of our profession. Everyone will know Chinnsamy sir. I mean, there is not one single person in this room who will not be aware of him, and he is a very good friend of SARC and ICAI, and he'll always, immediately accept whatever we request him to do. And Ind AS 118 is one of the most important accounting standards, which is coming very soon from April 2027. ROHIT Kumar AGRAWALA sir, what do I say about him? One of the most accomplished chartered accountants. I would say he's a gem of the profession who's actually, right at the top. He's broken many glass ceilings. He's having one of the biggest Navratnas in the country, and it is actually, very inspiring. Even now, after so many years of practice, when he speaks, I feel very inspired. Thank you very, very much, sir, for coming here to share your knowledge and experience. And AKSHAY JALAN, who is going to actually walk us through the Ind AS 118, and which is here to actually bring us on par with the global accounting requirements. The borders have diffused, and businesses are global and transcontinental. Whatever you want to say, you can talk about the businesses nowadays, and it makes sense for all the accounting across the world to have the same standard of presentation and disclosures, so that stakeholders across the world can actually understand what is being spoken of in a P&L account in India, in US, in China, in any country, and
the granularity which this presentation is going to bring is actually going to help the common stakeholders, and of course even the most important higher ones. Anyone who reads a balance sheet can actually understand the standardized and the consistency in which the P&L is going to be presented, and it's going to bring in a lot of clarity and understanding, and it's going to put us there on par. When we talk that India is going to be the top 2 or top 1 right there on top of the stack, we should actually lead by our financial disclosures, and reporting should also be there or right on the top. We are now the largest accounting body in the whole world, and we actually have to ensure that not only in terms of numbers and other things, the professional representations which we do, the professional work that we do, for which we are sought after across the world, our figures should also speak for us, and disclosures should speak for us. And this is where ICAI has made it mandatory from April 2027. And I think that we should thank the chairman of ASB for actually initiating this program today from Chennai with the leading lights in the profession. Thank you very much, sir. And I know how tough it is to come to this location for everyone. There is no parking, metro is there, and in spite of that, if people are coming here, it gives the picture of the importance that the members here in Chennai actually give for these kind of highly technical topics. So thank you once again to all of you, sirs, for actually sir, for enabling this program, and all the speakers for actually coming here to share their knowledge and experience. And of course, I always say that, I recently attended a program by the NEFRA chairman, and after going there, you kind of feel very confident. Yes, the CA profession, whatever the media is talking about, whatever everyone is talking about, we are here to stay. No one can take our place. And if NAFRA is passing some orders, it is only some orders. It is not all on the work of all the chartered accountants. One major point which we should all remember is NAFRA, even if NAFRA is here to say, we are the people who are actually feeding NAFRA, and the more we attend such programs from ICAI, I'm sure that the orders which is given by NAFRA is going to decrease in that proportion. So thank you very much everyone for attending today, and thanks again to everyone. Thank you. And I also wanted to update on 26th Republic Day. We are having a flag hosting here in ICAI Bhavan at 9 a.m. in the morning. I request everyone to come here. We are trying to make it very memorable. 9 o'clock is a flag hosting. We are then having breakfast, and we are having a musical event with patriotic songs, and we are requesting chartered accountants to come here and showcase their talent here, and we will also be giving merit awards for students and honoring senior chartered accountants, and we'll be finishing off with the grand lunch. It will be great if people here could tell their friends, and everyone can also come here and participate and show our patriotic fervor to this country, because we always say we are partners in nation building, and we should actually honor the flag by coming here and participating in the flag hoisting. So welcome to everyone. In February, we have a lot of programs planned. So please join us. We are having a budget program on February 3rd, for which we are having some, we have invited some really sought after speakers, and we will be announcing the names and details shortly, but it is on 3rd February at Savera Hotel. So please do register for the same also. Thank you very much.
Thank you for the insightful welcome address, ma'am. Now, CA Dr. Sanjeev Kumar Singhal. He is currently a chairman of the Accounting Standards Board, Central Council member of ICA, and partner at SR Butley Boy & Co. LLP. With a PhD in International Finance and over 27 years of professional experience, he has held leadership roles across industry and practice. He has 1,500 plus knowledge sessions across 10 plus countries, 15 books and 50 plus research papers to his credit. He has chaired key ICA boards such as Auditing and Assurance Standard Board and Sustainability Reporting Standard Board, and notably led international forums. He's a chairman of ASB. So we would like to give some words on the topic. Thank you. We invite chairman.
Thank you. Very good evening to all friends. The chairperson of SIRC, CA Revathi Raghunath ji. My colleague in the council will join shortly, CA Rajendra Kumar P. And the three very esteemed panelists of the faculty, starting from the left, CA ROHIT Agarwal. I know Rohit since last more than a decade. He has been a member of the Accounting Standard Board and he has led the financial reporting at the India's largest Navratna Indian Oil Corporation. He was the Chief General Manager there at Delhi, and then he was given the responsibility of being the Director of Finance at Chennai Petroleum. And he has led not only financial reporting but sustainability reporting also here, professional to the core. And I can tell you that going by his age and knowledge, one day we will see him as the Chairman and Managing Director of Indian Oil, not only as Chennai Petroleum. I am very sure about it. That's the acumen of Rohit, and he's with us on a very short notice. And second is Chinnsamy Ganesan. I know Ganesan since the time I was a member of ASB. I came to the council in 2018 elections, but I have been in the Accounting Standard Board since 2009. When Amarjit Chopra ji became the president, he has taken me as a special invitee in the Accounting Standard Board. So that is the time since then I know Chinnsamy Ganesan, and we have taken many sessions together. With the fond memories of our meeting at Bangalore Airport, where we were able to get about 2 hours time. And Ganesan has seen various facets of the profession and life, and whenever we need Ganesan, he's there. Today MP Vijay Kumar, who was my chairman at Accounting Standard Board, was also supposed to be there, but he had to travel to Mumbai. Otherwise it would have been a pleasure to have MP Vijay Kumar also. And then see AKSHAY JALAN, whom though he's a partner in my firm, but in Chennai I'm meeting him for the first time. I've never been to my Chennai office, and I must admit that I recognize him because of the photograph that I've seen in the flyer. But an expert in the Ind AS that I know. Being a council member, we don't get time to attend to our office. Normally maybe once a month I'm able to go to my office in Delhi, right? And no question of going anywhere else. But that's the beauty of the council and beauty of the firms who spare their partners for the council, and all 32 elected members give their heart and soul. And then there are 64 regional council members like Madam Revathi is there, and then there are 1,000 plus branch managing committee members. So friends, it's indeed a pleasure to be here, and as Revathi Madam said, it's the first program on Ind AS 118 that we are doing. Only last week it's been sent by NFRA to MCA. I'm a member of the NFRA board, being the chairman of Accounting Standard Board, and it's been documented in the NFRA minutes that ICI, or particularly ASB, been doing the programs throughout the length and breadth of this country on Ind AS 118, because that's a very, very important standard, and we welcome our very, very esteemed council colleagues here, Rajendra Kumar P. We are batchmates in the council since the 24th council. We are together for 7 years. A great scholar, an academician to the core, and a person who keeps the flag of the profession flying high. As of now, RK sir is handling 3 very important portfolios. He is the chairman of GST committee, and as a chairman of GST committee, he has made such impeccable relations with the GST commissioners and the entire GST leadership of the country. Last week there was a program in Thiruvananthapuram, and that's a routine for him. The kind of programs that he does for the GST, it's really commendable. In fact, even if he handles only one GST, the contribution that he has made is immense. But he handles two more important portfolios. Second is MSS, Member and Student Services. So all the 15 lakh members and students, 4.5 lakh members and more than 10 lakh students. So he takes care of them in terms of resolving the issues. The minutest of the issue, for example, my firm had this thing S.R.Butley Boy. Now that issue also he resolved. Now can it be called as S.R. Butley Boy? So the minutest of the issue,
Amended the instruction.
he amended the instructions. That is the level of the details that he goes, and he called the meeting of all the people of MSS and resolved every possible issue which were pending for almost a decade. And third is, we call him the presiding officer. Not for nothing. He is the presiding officer or the chairman of the board of discipline. And he has held more than 100 meetings of the BOD. And if I'm not wrong, maybe 1,500 or 2,500, 2,500 PFOs?
5,000 matters handled.
5,000 matters he has handled in 3 years. 5,000 matters he has handled in 3 years. He's a man on move, right? Travels throughout the country. He will hold a bench where the members are. And apart from that, he holds many international forums, but he leads the Edinburgh group, a very, very prestigious group for the Institute of Chartered Accountant of India. Very rarely you get a leadership of a group like the Edinburgh group. A great singer, R.K. Bhai, knows many languages. And every time we have a get together, we request him to sing. I don't know whether he sang here also or not, but yes. So on his invitation, I came here and he's coming straight away from the airport. But that's our relationship. As I said, 7 years we are together. Of course, he has been in the council prior to that also for one term, and one of the the leading light of the profession. So friends, I was talking about the topic 118, and since we have committed to NAFRA that we will be doing the programs throughout the year, and right now WOFA is coming. So actually CP programs are not happening, but because it's documented in the minutes, so we took special permission from the President Office and are holding this program. We held one webinar also yesterday on 118, in which our legendary past President Manoj Fadnisji was the keynote speaker, and Mr. Sandeep Gupta was the, he gave the keynote and Mr. Sandeep Gupta was the speaker. We'll be holding these programs immediately after WOFA on a large scale, along with Vishal Bhai Doshi, who is my vice chairman. This Ind AS 118 will redefine the presentation and disclosures in the financial performance of entities, particularly with regard to the statement of P&L. AKSHAY will be dealing it in detail, but it will give the granular details of the profit and loss. Profit and loss will have many more line items, and it will have a classification of the line items into operating activity, investing activity, and the financing activities. More importantly, it also deals with the management performance measures, because there are non-GAAP measures which the management gives. So it gives a guidance on that as well. So AKSHAY will be talking about that in detail. Of course, as the chairman of the Accounting Standard Board, we have gone through this entire process. See, the process of making an accounting standard in Ind AS mandatory is that first the matter is taken up in the Accounting Standard Board meeting. Then usually a study group will be formed, which is led by one of the council members, and any number of experts, could be 3, 5, 10 experts. They will submit their report, and then that will be deliberated in the Accounting Standard Board again. Then it is taken to the council. Once the council approves, exposure draft is issued. Once the exposure draft is issued, there are comments. Comment period ranges from 21 to 60 days. In this case, it was 60 days because of the importance of the standard. The comments are again discussed in the Accounting Standard Board and then taken to the council again. Once the council approves, these are sent to NFRA. And in the NFRA board, the standards are discussed. Once NFRA approves, these are sent to MCA with recommendation, and MCA notifies the standards. MCA holds a physical meeting before notifying the standard, in which ICI and NFRA both are represented. So presently we have two sets of standards, so as to say, accounting standard and Ind AS. Ind AS came in 2015. I was fortunate to be part of NACAS at that point of time. And in the first avatar in 2010, I was a member of Accounting Standard Board. I lived my life as an accounting standard man, though the last few years I've been focusing on sustainability also. Basically, in 2015, these became voluntary, and 16-17 they became mandatory for the listed entities, their subsidiaries holding associate JVs, and also the entities having a net worth of 250 crores or more, even though they are not listed. They were made mandatory in two phases for non-banking, non-insurance and non-NBFCs. And then the next phase came for NBFCs, again in two phases. Insurance and banking is still pending. Even in the last NFRA meeting, this was discussed, and they've been nudged to give a roadmap for the implementation of Ind AS in the insurance and banking sector. Now, apart from this formulation of the standard, Accounting Standard Board also issues guidance notes on certain matters. It has come out with educational material on a large number of standards. This year also we have finished 4 educational material. Then we work very closely with the International Accounting Standard Board. We give our comments on the exposure drafts. And this year we got a unique opportunity to train the officers of the CNAG in the batches of 50 each. And each batch runs for 15 days on Ind AS. It's a physical batch which we run in our Center of Excellence. And initially they said you train our 2,500 officers. Means 50 batches. 5 batches we have held so far. And going by the success of the program, they've extended it to 4,500 officers. That is present and future officers. So 90 batches will be done by the ICI to train the officers of the CNAG. It will have a benefit, dual benefit. One, we get to know more of the CNAG side, and secondly, we are teaching CNAG in the right earnest the application of Ind AS, because otherwise they will come to Chennai Petroleum and they say, no, this is the applicability and this is how it is to be interpreted. So we have requested all the faculties to teach them standards in a manner that gives the right perspective. And to the senior officers batches, we are sending some of our past ASP chairmen and the past presidents also to take up those sessions. Thirdly, they requested us on 15th of November that if we can develop the e-learning material. The Honorable CNAG came to our Hyderabad Center of Excellence on 27th of November, and they say if you can launch one e-learning. We launched 15 on that day. In 15 days, we gave them 15, 10 Ind AS and 5 AS. And yesterday, the Honorable President ICI has sent a letter to the Honorable CNAG that all the Ind AS e-learning materials are ready, all the AS are ready, and they've been given free of cost to the CNAG. So all the 39 Ind AS and the 27 AS e-learning material is ready, and we will launch it for our members also, probably either in VOFA or in the next council meeting. In 2 months flat, the faculty of ASP, faculty like Chinnsamy Ganesan and others have made sure that this happens. And we keep looking for more and more faculty. We need about 100 faculties. So if any of you want to be a faculty with us, please do so. We've also done a 2-day program for Security Exchange Board of India, senior officers on corporate fraud investigation. We also did a program for NSDL, Himachal Pradesh Electricity Board, and so on. We are also in the process of formulating the MCQs, and we have formed about 500 MCQs or so, but we are formulating more and more MCQs. And in the WIFA, in the ICI Pavilion, we are also keeping a quiz on accounting standards, and whereby the research questions will be asked, so that for the presentations in India and overseas, we have the research data collected, because that is one of the strength of the overseas body which we are lacking at this point of time. So starting with WIFA, we will be addressing that as well. So in accounting standard board, there are 75 plus members, and all the regulators are there, be it Ministry of Corporate Affairs, representative from SFIO, representative from Security Exchange Board of India, or all the chambers of commerce, CII, FICCI, SHM, IIMs, etc. RBI. It is one of the largest board of ICAI, and I'm really fortunate to chair this board this year. And again, as I said, my sincere thanks to my council colleague Rajendra Kumar ji, who has a very packed schedule. Day after tomorrow, Chingalpattu branch is also to be inaugurated again. All efforts to him. But still, he says, I will be available, and we are holding this program. And I got this opportunity to visit amidst all of you, and thank you very much for a very patient hearing. Thank you guys.
Thank you, sir, for your insightful words. Now, we would invite CA Rajendra Kumar P, Central Council member, to give few words on the topic. 8. Presentation and disclosure in financial statements, key provisions and implications by the speaker AKSHAY Jalan, CA. Yeah. AKSHAY Jalan is a chartered accountant working with Ernst & Young as a partner in their financial accounting advisory service practice. Has extensive experience of more than 16 years in client service in areas of statutory audit, accounting advisory and IPO advisory services. Specializes in technical accounting under Ind AS and IFRS, and has supported numerous clients with expert guidance on complex topics such as business combination, consolidation, revenue recognition and financial instruments, etc. May I request CA Revathi Raghunathan, Chairperson SIRC of ICI, to present the memento to Mr. AKSHAY Jalan.
This is data will be 5 minutes because we don't need to order people who have spare their time.
May I request CA Dr. Sanjeev Kumar Singhal, Chairman ASB, to give memento to CA Dr. Chinnsamy Ganesan. And shawl. Now I request CA Rajendra Kumar P, Central Council member, to hand over the memento to CA ROHIT AGRAWALA. Now I request Chairperson CA Revathi Raghunathan to hand over the memento to Sanjay Kumar Singhal, Chairman ASB.
SIS, not completed.
Now I request our Chairperson CA Revathi Raghunathan, SIRC of ICA, to hand over the memento to CA Rajendra Kumar P, Central Council member.
Yes, absolutely. I have to show it to you. What Revati has told. Golden, not very, but type of golden plant. So nice. Appreciate it.
Now I request C. Akshay Jalan to give about his session. Technical overview on presentation and disclosure in financial statements, key provisions and implications. Over to you.
Hello. Yeah. Good evening, everyone. So first, thanks a lot to Sanjeev Kumar sir and everyone to, have invited me here to be a speaker among the giants, right? Good that Sanjeev as well as all the giants now at least have a face to the photo, right? So today I'm here to talk about the next 45 minutes to 1 hour I'll spend, talking about a very new and an interesting topic, which is Ind AS 118, right? This is a very exciting topic, right? Why I say exciting? Many of you here must be in the practice, right? I advise clients, right? It's been almost 7 years that there has been a new accounting standard. We had a lease standard and a revenue standard which came in 18 and 19, right? If there is no change to the accounting standard, from where do we make money? Where do we advise clients, right? So that's why this is very exciting. We have been waiting for long that something should change, right? So it's after 7 years, and this is something which has far-reaching consequences across the entire gamut of companies, right? There was, of course, the insurance standard which came 2 years back, but however, that was to a very limited set of companies, right? This is something which has implications across, right? So on the lighter side, but whenever, a new standard comes in, right? There is a lot of history behind a standard as to why it is happening, right? It's not a standard which just changes for the sake of it, right? IASB has been working on this standard from 2016, right? They have been getting feedback from a lot of users in terms of, what do they feel about financial statements? What is missing in a financial statements? What do you want more? And this project finally culminated after 8 years in 2024, when IASB issued the IFRS 18, right? And which is today mandatory from 1st January 2027 across the globe. Who are the countries are applying IFRS, right? Now, ASB, based on IFRS 18, issued an exposure draft in 2025, May 2025, which was open for comments for 4 months, right? And this was more or less aligned to IFRS 18 with few terminology and other changes. Otherwise, it is more or less aligned, except an applicability date where IFRS is applicable from 1st January 2027. But in India, Ind AS would be, if once notified by MCA, would be applicable from 1st April 2027, right? Like Sanjeev sir mentioned, now in the meeting which is held in December and January, through IASB and NAFRA, the exposure draft has been recommended to MCA for notification. It's expected to be notified soon, right? Now, in the notification, there have been no changes which have been made to the exposure draft. If some of you here have already read the exposure draft, only couple of things in terms of the applicability date. One recommendation was made that there will be companies whose year end is going to be December. Not everybody in India follows a March year end, right? So there was one more applicability date which was suggested from 1st January 2027 to align with IFRS for companies which are having a December year end. And obviously there were recommendations made to MCA as well as SEBI to align both the Schedule 3 as well as the SEBI LODR requirements in line with the new standard. Right. So this new standard today now replaces Ind AS 1, which is our current existing standard on presentation, right? So though there is a complete new standard and Ind AS 1 has been replaced, right? But everything in the standard has not changed. Everything in the standard has not changed. There are a few things which are changed. There are a few things which, obviously a language and the format of the standard has changed, but there are a few things which remain the same, right? The way we look at our balance sheet today, it's exactly the same. There is nothing which the new standard brings new to the balance sheet, right? But there are 3 key changes which this standard brings in. First is the way the profit and loss account looks. There are 3 new categories which have been brought in the profit and loss account. I will go ahead in detail on those, right? Second aspect which the standard has brought about is management performance measures, right? These are performance measures which are not there in the financial statements. These are outside the financial statements. Historically, in India, we are never used to seeing any measures outside the financial statements, right? And third is there are enhanced on agriculture.
So this is how the new statement of profit and loss account will look, right? Now, if you see, there are actually the standard says there needs to be 5 categories. It has divided the profit and loss account into 5 categories. The operating category, an investing category, a financing category, a tax category, and a discontinuing category, right? Tax category and discontinuing category were there in the erstwhile standard, and we are aware of those, right? It now brings in 3 new categories, which is operating, investing, and financing, right? Plus, it brings 2 mandatory subtotals which every company needs to disclose in their profit and loss account. The first one being operating profit, and the second one being profit before finance and income tax, right? So it's mandatory. These 2 subtotals are mandatory. You cannot edit these, right? You may add new subtotals if required, if you feel so. And these are the 3 categories which the standard now requires you to show. Right? I'll get into each of these categories. First one being operating, right? Operating, as we all know, will mean generally what are my main business operations, right? If I'm a manufacturing company, it may be a manufacturing, a service industry, or what are my operations? So generally operating activities would cover what is your main business activity, right? But the standard doesn't, it's not an exhaustive list of an operating activity. When I come to investing and financing activities, there are, what is included, what is excluded, but operating is not an exhaustive list. It just says anything which is your main operations plus anything which does not fall into any other categories. So it is a residual or a default category always, right? It is assumed that anything which doesn't fall into any other category will obviously be related to your business. It can't be outside your business. They are not going to be personal expenses. You are going to be sitting in your profit and loss. So it's a default residual category. It is not that I'll have to go and find out, everything which, whether it pertains to operations. It will always be a default residual category. Okay. Now this is the second new category, which is an investing category. Okay. I don't know if you noted that in the profit and loss account, though we have these 3 categories, actually subtotals are not there in the profit and loss account saying this is my investing profit or loss, or this is my financing profit or loss. That kind of subtotal is not required in the statement of profit and loss account. These are just categories which have been defined as to where and how they need to be presented in the statement of profit and loss account. Okay. Now, investing activity, typically the standard lays down 3 types of assets. But if you are investing in these assets and your purpose of investment is that, right, those will fall under an investing activity, right? The first one is income and expenses generated from income and expenses from assets generating returns individually and independently from the rest of the company, right? Now, to say if you invest in a mutual fund, right? Invest in a mutual fund, it's in the market, it's traded in the market, you will get your returns independent of what is happening in your operations in the business, right? If you rent out a real estate property, right, which is not part of your business, you are going to earn returns from that real estate property independent of what is happening in your own business. So the first category of asset is any asset which is any return from an asset which is independent of the rest of your business, it's able to generate returns, right? Second category is income from investments in associates, joint ventures, and subsidiaries. That will fall into your investing category, right? Now, subsidiaries, in a standalone financial statement, we have subsidiary investments. Therefore, there may be income or expenses pertaining to a subsidiary in a standalone. But in a consolidated financial statement, you will not have subsidiaries, right? So in a consolidated financial statement, the treatment may be quite different. Last is cash and bank. Cash and bank, where balance which is sitting in the bank will generate its own return. Whether your business does well, does not do well, it is still going to generate its returns, right? So those are the 3 categories of assets, which the standard says if you have returns from any of these 3 categories of assets, this will be categorized as an investing activity, right? So now, not that every income or expense pertains to these will get into an investing category. There is a specific definition that these are the types of income and expense only can go into the investing category. Okay. So there are 4 types of expenses with the standard list now in income and expenses. One is income generated from these assets. Any income which you generate from any of these assets, which may be in the form of interest income, it may be in the form of fair value gains, or any sort of income which you generate from these assets. Second is income or expense on initial as well as subsequent measurement of these assets, right? So there may be assets which you carry at cost, there may be assets which you carry at fair value, right? Subsequent, every year you may be remeasuring these assets at a fair value, right? So this remeasurement, profit or loss, will also go into the investing activity, right? There may be expenses which you have incurred on day one to acquire these assets, right? That is also a part of investing activity. When you sell the assets, you may incur cost to sell these assets. That is also a part of the investing activity. Finally, when you sell, any loss or gain which you get on this also will be an investing activity, right? Reading this, it appears as if every expense is there, right? Whatever income or expense could fall into any of these assets is there, but no, that's not the reality, right? Maybe I'll explain this better with an example, right? Okay, so you have a rental property, right, which is an investment property, right? Is that fine? No? Okay. So there is an investment property from which you're getting rental income, right? There are different types of income and expenses which the company may have from this rental property. One is there is maintenance charges which you pay for that. You may be paying municipal taxes. You may be paying under repairs and maintenance. You may be paying some service, and there may be security, there may be things like that. All of those expenses you may be incurring in relation to this property. There may be transaction cost which you are incurring when you sell this property. When you are selling property, there will be a transaction cost which will happen, right? There may be employees who monitor this property. Like I mentioned, a security person, right? Now, though this property, first we'll do a two-step approach. The first step is whether the asset individually is able to generate returns separate from your business, right? Once you tell it's an investment property which generates rental income, it is separate from my business, so it will satisfy the asset test. Second is the expense, right? Now, not every expense, we discussed that there are 4 types of expense only which the standard allows to be categorized as an investing activity, right? So when we see here, right, what we spoke about was income from the asset, cost of acquisition or cost of disposal of the asset, initial measurement or remeasurement of the asset, then the last one was profit or loss on the disposal of the asset, right? So when we try to fit all these expenses in these 4 categories, right, we will see that the maintenance of the asset or the costs relating to the employees of the asset, these are regular recurring costs. The standard does not allow you to put it in investing activity. So this will go back to your default category of operating activity, right? So it's only those 4 categories of expense which the standard says that only is very specific categories are allowed in the, right? So relating to this same investment property, rental income will be in investing category. When you sell, a profit or loss will be in investing category, but expense pertaining to maintaining of that property, right, will not be there in the investing activity. Clear? In case anybody has any doubts, you can stop me there and there also, no problem. So if so you will see maintenance is a regular cost which you have to do, right, irrespective of this. So the standard intention is not to derive a profit or loss from an activity, right? So if you are in a real estate business, you will want to know what is my profit from that property. That is not the intention. That is not the intention of the standard. The intention of the standard is to just show the users from investing activity what is a separate. I am not trying to show a profit or loss. This will never give a picture of a profit or loss, right? Plus, there may be always interchangeable common cost which you have with your regular businesses, right? Like we saw in this example, the same employee will be taking care of that rental property also, he may be taken. There will always be common cost. If the standard gets into this sort of division, then you may land up actually ending up dividing common cost. I may have to sit and identify what is the common cost which pertains to this property and then arrive at the profit or loss. Okay? Sorry.
In that case, you can earn only revenue from investment activity. It cannot be shown as the income.
You want me to use this now? So revenue and income are quite interchangeably used, right? In the Schedule 3 also it used to be called as total income, not as revenue. So income does not necessarily mean profit. Okay, so I think this is a quick snapshot of, what the standard says in terms of, sorry, yeah. So impairment loss would generally come as a remeasurement, right? Whenever there is a measurement or remeasurement of the asset, there will be an impairment loss which will happen, right? But first, goodwill should satisfy the test of independently generating cash flows. Right? Goodwill can never independently generate cash flows, right? So impairment on goodwill is not something which is going to come here. But if you have an impairment on a investment property, that is going to come here. Yeah. 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 Correct. 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 Investment at amortized cost. Okay. So if it's an impairment on investment, it's different from an impairment on goodwill, right? Both are not the same, right? Yeah. Goodwill will not come separate in an investment, right? So here we are talking about investment. Now, first in an investment, you would have an FVTPL investment. In case of cost is allowed only for investment in associate, subsidiary, joint venture. Cost is not allowed for any other investment because it will not meet your SPPI criteria, which is solely payment of interest. So that it will not meet, right? Now, in a standalone financial statements, it will always be only investment. There is never going to be a goodwill which will come in your standalone financial statements, right? Once it's investment, there will be an impairment of investment. There will not be an impairment of goodwill. Impairment of investment will satisfy this and it will fall an investment activity. Once you come to your consolidated financial statements, the investment is not going to be there. There is going to be assets, there is going to be liabilities, and there is going to be goodwill. So there will be net assets and goodwill, right? So this now becomes a part of the business. This will not even satisfy your asset criteria in terms of whether this is an investing asset at all. The entire business, including assets, liabilities, net worth, and goodwill, now together is a package. There, when you impair the goodwill, it is not an investing activity, it is part of your regular business. Right? Clear? So just a quick recap because it's an important one, right? I'm just doing a quick recap. So there are three types of assets which the standard defines as what can be categorized as those assets for which you can classify an investing activity. There are four types of expenses which the standard says not every expense related to those assets gets into investing activity. Okay? Regular repair and maintenance, day-to-day operations of those assets will not get into investing activity. Okay. The next category is financing category. Right? Previous category we spoke was an income whenever I invest. This category is a financing category whenever I borrow. Right? Now, when the standard talks about financing category, it has tried to divide it into two types of liabilities. Right? One is a general liability where it's a pure finance arrangement where I take a bank loan. Right? It is a pure finance arrangement. Right? In case of pure finance arrangements, the standard says all income and expense pertaining to those finance arrangements will always be classified as financing activities. Second type of liabilities, right? In Ind AS, I think you must be aware that lot of regular items, there is an imputed interest component which comes, right? So in a lease liability, there is an imputed interest which we are supposed to bring in. In revenue standard, there is a significant financing element which is there in the revenue standard, right? When you do an actual valuation of a pension benefit, there is a discounting element which is sitting inside there, right? So inherently, under many of the accounting standards, an interest expense comes into the P&L on certain regular items. So the standard takes out separately that these types of liabilities do not classify all income and expenses as financing activities. Only the interest portion or an unwinding of the discount portion relating to these liabilities to classify as financing activities. The rest will be your regular business operating activity. Okay. So you may have a trade payable with extended credit terms, right? So there will be a discounting element which is sitting on that extended credit term. That discounting element interest portion alone will go into the financing activity. The regular trade goods and supplied on or goods and services received on the trade payable will always be in your regular P&L, in the operating activity. Right? Okay. So we are very used to this operating, investing and financing in a cash flow. We are used to this operating, financing and investing in a cash flow statement, right? But if you carefully solve these definitions, these actually do not match with the cash flow statement. An investing activity in your statement of profit and loss account is not equal to the investing activity in your cash flow statement, right? The classic example would be property, plant and equipment. Purchases of property, plant and equipment in your cash flow statement are an investing activity. But property, plant and equipment in my P&L is regarded as a regular business operation and thus does not get into investing activity but will get into operating activity only, right? So both terms are similar but they are not the same. The components of them are not the same. Obviously there is a dichotomy. Today the cash flow standard has not changed. Maybe in future, in order to avoid confusion, there may be change which we can envisage on this, right? We spoke about investment in subsidiaries, investments in associates, joint ventures. We spoke about standalone and concern. That's okay. Now, one interesting category is this applicable to all companies, all type of companies, right? So there are banks. There are companies which are engaged only in investing. Their business itself is only investing, right? The first category is an operating activity, which is your main business, right? If your main business itself is financing, what do you do, right? So that's why the standard has gotten this concept of specified main business activities. Okay. So for any company which is not into a specified main business activity, we will follow the general rule of classifying operating, investing and financing what we just spoke about. For any company which is in a specified main business activity, which is either you are just in the activity of financing, which is maybe a bank or you may be an NBFC, or you are in the activity of investing, which may be a real estate company, right? So in those cases, when you have a specific business activity, your general model will not apply in its entirety. Some expenses which in your general model were in investing category will get moved into an operating category. Some expenses which in your general model which were in your financing category will get moved into an operating activity, because the standard recognizes that this today is your main business now. You cannot always classify these as investment financing. Right. Okay, identification of main business activity itself is an area of judgment, right? It is not as simple in reality that there is only a bank or there is only an NBFC, right? You have large conglomerates, with 200, 300 subsidiaries, each subsidiary in different businesses, right? Out of 300 subsidiaries, maybe 50 subsidiaries may be an NBFC, right? Some other businesses. So that identification itself is an area of judgment, right? One of the areas where the standard discusses is the segment disclosure, right? In segment disclosure, when you have many businesses, right? Say if you say this, there is a manufacturing segment, there is a service segment, there is a providing finance to customer segment, there is also an investment property segment. There are 4 segments which are available in this company, right? Finally, your financial statements will be disclosed. They take the first 3 together and disclose it as one segment based on a segment standard. All the criteria have been met, right? And the last, the 4th activity, investment property, is a separate segment, right? So in this case, you actually have one specific business activity which is investment property, and rest are all your general businesses. Providing finance to customer will not be again a separate business activity, because that is part of your overall segment with other businesses, either based on materiality or other similar characteristics, is considered part of other businesses. So for business activity A, B, C, which is 1, 2, 3, we will follow the general model. Only for business activity 4, we will follow a specific model. Right? There is a very similar example. Instead of segment, it is talking about subsidiaries. Okay. So now in this model, what are we supposed to do? Whenever there is an income and expense from an investing activity, which is those 3 types of assets which we spoke about, right? Standard says investment which are accounted under the equity method, which is an associate or a joint venture. Those are specific unique investments, right? You then control them. You are only there for the sake of getting your profit, right? And users always want to see this differently from the rest of your business, right? So whether you are in an investing business or whether you are in any other business, investment in an associate which is carried at equity, using equity method will always be accounted as an investing activity. It will never move into an operating activity category, irrespective of your nature of business, right? All other investing activities, other than investment in JV which is carried at equity, if you are in the business of investing, will move into operating. If you are in the example which we spoke about real estate, if you are in the business of real estate, all of those will move into operating. And you may have nothing left out in investing category at all. Right? In case of financing category, if you are a bank or an NBFC, or if your main business is providing finance, there are 2 types of liability which we spoke about. Type 1 liability, which is a pure financing arrangement, and a type 2 liability where there is an interest component sitting, right? Now a type 2 liability is any, irrespective of your nature of business, it is peculiarity of the standard. There is a significant financing component. So it has got nothing to do with your business as such, whether you are in a financing business or not in a financing business, that is going to remain as it is. On a lease liability, you are going to still account the interest expense, right? So on a type 2 financial liability, nothing changes. Whether you are not in a financing business or whether you are in a financing business, you will still continue to account it in the same way. That is, interest expense will be in the financing category and the other expense will be in the operating category. On the type 1, which is pure financing arrangements, right? This is where now you are in the business of financing, right? Which the standard does not actually force you to move this to operating category, but gives you an accounting policy choice. You are free to choose whether you want to show this in a financing category or in an operating category, right? Some companies may not want to take it in operating. I am a finance business. I want to show this as a finance. I want to use the word financing and not use the word operating. So here there is an accounting policy choice which is available, right? So any company which is not in the specified business activities will always follow the general model, classify into those 3. If you are in the specified business activities, in case of investment companies, other than investment in associates and JVs carried at equity, everything else will move into operating. In case of financing, for type 1 liabilities, you will have an accounting policy choice, right? Okay, maybe this is just a small example here in terms of, how your P&L changes now from your old classification to your new classification, assuming you are a normal manufacturing company and not into your specified business. Revenue from contract from customers will continue to be operating. It is part of your operations, right? We are used to showing a lot of items in other income. Lot of items in the other income, the top line which comes into our total income, right? Now, this is where many of your items would actually come out of operating and move into something called as investing, right? Generally, your PPE disposal sale, that is the only thing which will remain there as an operating activity. Rest, most of them, your dividend income, interest on debt instruments, FUT gain loss, all of these will actually move into your investing activity. So all along the total income which you are used to showing a very big number will now really show only your real operations, right? COGS will mostly be in your operating employee benefit expenses, right? In employee benefit expenses, there will be gratuity provisions, right, which we spoke on a type 2 liability. A gratuity provision will have a component of interest unwinding discounting which is sitting inside that liability, right? That portion alone will have to be carved out and moved into financing. The rest all will remain in operating. Sorry. It is feasible because in your actual disclosure, they actually give this number separately. What is your interest cost? What is your current service cost? The AS15 disclosure which comes in your finance, which he actually provides, he actually gives these numbers separately. OCI is only actual gains and losses. Current service cost doesn't get into OCI. Right? Okay. In finance cost, right? Again, in finance cost, most of the interest expense will go into finance expenses. Something like bank charges, right? This is a typical, so cash and cash equivalent is actually an asset which is defined in the investing category, right? But this does not fall into the 4 expenses which is mentioned there. It does not really fall into that mode. It's neither a return, it is neither a profit or loss on disposal, neither an acquisition, neither on remeasurement. Okay, this is a charge which you're maybe a regular charge for maintaining your monthly balance or something, right? So this will go into your operating activity. Depreciation, PPE will remain in your operating. If you have investment properties, that depreciation will get carved out into investing activity. Okay. Impairment, trade receivable impairment will get into operating. If there is an investment impairment, it will go into investing. So I think these are regular things. One peculiarity here is the foreign exchange difference, right? Now foreign exchange difference will be across many items, right? The standard requires that foreign exchange pertaining to each category has to accordingly be classified into the respective category. So foreign exchange pertaining to a trade receivable or a trade payable will go into operating activity. A foreign exchange pertaining to a cash and bank or an investment balance will get into investing activity. A foreign exchange pertaining to your borrowings will get into financing activity. So foreign exchange can no longer be sitting as one line item in your statement of P&L. It will go into respective line items, right? The only small exception which is there in the standard is if there is undue cost and effort involved in splitting this, right? So today your ERP is not supporting. You do not know how to really break this, right? The number of transactions are so huge. You have a lot of subsidiaries, you have intercompany transaction, right? If the cost is too huge to really split this, that is where the standard allows you that without splitting, you show it in one line item, right? Yeah, operating, right? And the standard doesn't allow you to split a forex on a single item into 2 categories. Okay, like we spoke about type 2 liabilities, right? Where there is an interest component of a liability and a regular component. So you can't take the forex on the interest component alone and putting in financing and the rest into the operating. That is not allowed in the standard. That will always be into one category. Okay? Yeah. Both. Net. Yeah. Yes. Yes. Yeah, it will be there only in financing expense always. It cannot move into other categories. Right? So I think overall we have covered the 3 new categories, right? And next we will discuss on classification of expenses within the operating category itself. Okay. This is something new which the standard has brought in, which we are not used to in India, right? Which is the functional classification of the statement of profit and loss account. Globally, most of the companies do a functional classification, but in India, both Schedule 3 as well as Ind AS 1 had done a carve-out from IFRS where functional classification was not allowed, right? Now, the standard has brought back functional classification, right? So, functional classification is basically your function, right? So, cost of goods sold, cost of manufacturing function, sales, there is a sales function, there is an administrative function, right? There is a research and development function. That is the function. Nature is salaries, right? Now, a salary expense may relate to a sales employee, a salary expense may relate to a manufacturing employee, or a salary expense may relate to an R&D employee. Traditionally, we are used to showing everything based on nature, which is salary expense, depreciation, that. Now, the standard says you can follow a function classification, right, which is show this by your actual functions, okay? Or you may also do a mixed. Not necessarily everything needs to be nature, not necessarily everything needs to be function. There can be mixed also possibility, right? Now, this is not an accounting policy choice. This is not an accounting policy choice. You actually have to go ahead and assess which type of presentation best depicts your business and is best for the user to understand your business and its financial statement. So, it's not an accounting policy choice, right? You have to actually do an assessment, right? And what factors actually you see to do this assessment, right? First is your management. How do they view the business, right? Most of the standards today in IFRS are starting getting aligned to how management really views the business. That's the same way a user needs to view the business, right? If the promoter, CEO, managing director, board, they are used to reviewing the performance of the company as a function, as a functional P&L, right? Then that would be the appropriate method in which the users of the financial statements also need to see the P&L, right? So, you should go by function, right? So, first is the how management really uses performance. Today in India, you will see most of the times your P&L and the MIS do not talk to each other, right? Because P&L has a strict Schedule 3 Ind AS 1 classification, which is always nature. But management may not be interested in viewing its performance by nature. Management may be interested in viewing its performance by function, right? So, the first step is to see how the management views the business, and that's how you should replicate it in your statement of profit loss account. Second would be what are your profitability drivers, right? How do you control your cost, right? Do you control cost, say, I want to control my salary cost and that is what is going to improve my profit? Or do I control cost saying that I want to control my selling cost? That is what is going to control my profit. So, what is really the driver? What is my cost driver? Whether my cost driver is dependent on the nature of the cost or whether my cost driver is really dependent on the function. That would be the second, right? So, these are internal things which are available. Third, obviously, is industry. People in the same industry obviously would be viewing performance in a similar way. It is not going to happen that, a retail person, management of a retail industry in one company would view the performance differently. If somebody is viewing by function, as an industry, it would be a trend that everybody would do function, right? So, industry is the third important external evidence which gives that either you go by a function or by your nature, right? Now, the standard also allows mixed presentation. The reason for doing that is you may have a lot of different businesses. Not necessarily every business is going to be either viewed by nature or function, right? Some business you may view as nature, some business you may view as function. So, that's why standards allows that depending on how you view the business, what are your drivers, the respective businesses, you can follow a mixed presentation. You are allowed to follow a mixed presentation, right? And many of these today are sitting in your MIS. They are not, subject to a scrutiny, not given to public, right? So, whenever you review, you may have made some ad hoc mechanisms. Everybody is obviously going to have a common cost. Every company will have a common cost. So, when my CEO reviews a functional P&L, right? Some common cost, there may be some basis which we would have allocated, right? Now, that basis sometimes may be very arbitrary. It may not have a proper rationale. Right? Once you come and disclose this to the users, you can't go ahead and use that basis for the allocation. Some expense you may not be able to allocate at all, right? Say an impairment expense of a goodwill, like you mentioned, right? An impairment of a goodwill may not be to a particular line item or a function. It is to your organization as a whole. You cannot try and allocate that to a particular function or to a particular nature, right? So, the standard understands that and leads you to do a mixed presentation. Whenever there are such arbitrary allocations which are happening, you can go ahead and show the nature even though your entire P&L is based on a function. Okay. Now, whenever you follow a functional classification, okay, the standard requires that at least 5 items, okay, which is depreciation, amortization, employee benefits, impairment, as well as inventory write-offs. These 5 items you will have to disclose in a particular note as a total of these 5 items, right? So depreciation in a functional P&L may be sitting in COGS, may be sitting in administrative expenses also. And the standard requires you total both of them in one place and disclose them. So once you are doing a functional, at least these 5 items at the minimum have to be disclosed in your notes to accounts in the from the respective categories. Okay. Okay, so we have finished the first section, which is on the categorization of the P&L, right? The second section is on management defined performance measures, right? Now, management defined performance measures are measures which are not there in your, traditionally not there in your statement of profit and loss account. They are not there in your statement. They may be financial measures, they may be non-financial measures, right? India started, to some extent maturing for management measures, right? In terms of SEBI had come up a couple of years back that whenever you go for an IPO, right, you actually have to disclose what are your KPIs, what are your non-GAAP measures, right? And there are certain controls which SEBI has brought in around that as well in terms of those management measures, right? How do they compare to the peers? There is a disclosure which entirely comes in a DRHP. What are my measures? What are my peers' measures, right? And this is actually subject to an auditor's certificate as well. So India to that extent has matured towards a management performance measures, right? So now the standard recognizes that there are limitations in accounting standards. There is a particular way which you have to show your P&L. There is a particular way in which expenses have to be accounted, right? But you may want to show some numbers differently to the user to make him understand better. That is how you see the business, right? So traditionally, before a lease standard came in, everybody was used to seeing rent expense in your operating rate. Suddenly that rent expense has become depreciation and interest, which actually changes your EBITDA, right? Now there is a limitation of the standard. The standard doesn't allow you to change that, right? But as a management, I may still internally ignore that, and in my OMS, I may always see it as rent and a line item above EBITDA. I may always see it that way, right? That is a management measure. That is how I may want to show that is how I see my business, right? So that's the importance of a management measure, because all GAAP measures may not necessarily give the full picture. So a management measure is important, right? Now, how are management measures to be identified? One is, standard says that MPM is a subtotal of income and expense. So that is your start point, which is a subtotal of income and expense, right? It's a subtotal of income and expense. So just income can never be an MPM. Just expense can never be an MPM. A ratio can never be an MPM. It always has to be a subtotal of income and expense. Okay. Then it is used in public communications outside the financial statements. So these measures generally the management communicates to public at large, right? That would be our second starting point in terms of these are measures which are being communicated to public at large outside my financial statements. These are not sitting within my financial statements, but I am used to communicating these to the public at large, right? Next is, these communications which are made are actually the management's view. So that's how the management views the business, and that's why they are making these communications, right? The last filter is, this measure should not be required mandatorily in any case to be disclosed in some other accounting standard or in Ind AS 118, right? So operating profit is a subtotal which is there in 118, and operating profit itself can never be an MPM. There has to be a different measure, right? So any measures which are there in any accounting standard existing measure can never be an MPM. So just to flow this again, it's a subtotal of income and expense. You communicate this publicly in your to outside, right? Now the standard realizes today we are in the social media world. right? You may be putting things on Twitter, LinkedIn, social media. You may be doing all of that, right? That is, yeah. Yes, yes, right. So every communication which you are making externally, right? There is a reason why you are making externally, right? So that communication which you are making, identify it. That is what your management will. So you do it, bring it into your financial statements. Yes. Correct. Correct. Yes, yes. If there is a regular public disclosure which is made, right? Generally, in your regulatory disclosures, you may not have MPMs, right? You may do an ROC filing, which will be your financial statements. You may do your income tax filings. You may not have MPMs, right? Unless you are large private companies. Perfect. So we started with subtotal of income and expense, right? So it is a financial measure always, right? Which is a subtotal of income and expense. Other disclosures of your GNPA number of vehicles sold in an automotive company will never fall into an NPM category. They are non-financial measures. So it will always be financial measure and a subtotal of income and expense. Okay. So I was talking about public communications, right? Today there may be people in the communications which are happening in social media, right? A CEO may go and make a statement in a social media, I project my profits to be so and so, right? So standard understands that and those are excluded and they are not considered as public communications. So these are formal public communications, right? These are always formal public communications which are in the form of press release, investor presentations, other information which gets into your annual report, MD&A, management discussions and analysis. So these are all your formal public communications which happen, right? Oral communications or informal social media communications are not to be factored, right? So obviously there is going to be a need to have an interaction between your investor relationship team, your branding team and your finance team in terms of what communications today you are making to the public, right? Because I need a history of all those communications. I need a log of all those communications to understand whether they are MPMs, right? Once there is a public communication, right, there is a rebuttable presumption that the public communication is actually a management's view of the financial performance of the entity as a whole, right? There is no need to disclose something to the public which was not in a management's view or measure itself the way I see the business, right? It could happen that there is a regulation which requires to make a public communication on something, right? Now there is a regulatory requirement, but that may not be a management view. So I am forced to disclose something in public because there is a regulatory requirement. But that's not how I really view the business. That's not really my measure. So that is where you may come out of this rebuttable presumption that whatever is disclosed in public is a management's view, right? So once you have done all these filters, you have identified these MPMs. These MPMs are now to be disclosed in your financial statements. What is to be disclosed? In one note, we show that these are my MPMs. Qualitatively, what does this MPM mean, right? How did I calculate this MPM, right? And then a reconciliation of this MPM to a measure which is available in my statement of profit and loss account, right? Because we do not want some random numbers which do not reconcile to anything, right? Somebody has to be able to reconcile this back to the financial statements, right? So there will always be a reconciliation which will have to be presented to the MPM to the financial statements, right? Sorry? Yeah. It is mandatory to be there in your financial statements, right? So if you pass all the tests, there is a public communication which has been made, that is the management's view, and it's a total of income and expense. You will have to disclose that measure in your financial statements, right? In case over a period of time MPM changes, you may start looking at business differently. You may start not communicating certain things in public, right? So if there is a change, you will have to put the new MPM. You will have to restate your comparatives as well as per the new MPM. Say why did your MPM change, and all the respective disclosures will come in. Okay. So I think we already spoke on public communications. We already spoke on the right side says non-financial measures, right? The non-financial measures will never be an MPM. It will always be financial measures, but not all financial measures are MPM. It is only going to be, so ratios can never be an MPM. Free cash flow cannot be an MPM, right? Net debt cannot be an MPM. Adjusted revenue, it is just income. It cannot be an MPM. It always has to be income and expense. It has to be a subtotal of income minus expense. Always. That is how an MPM will be specified, right? So you have an operating profit, you may show an adjusted operating profit as an MPM. So there will be an adjusted operating profit will be shown as an MPM. Okay. Okay. So there are two ways, sir. There is, it will increase the burden definitely, right? But there is also greater level of responsibility which has been put on the company, that you are disclosing some numbers in public. No, public. So these are already numbers which are disclosed in the public, right? Now there is an added level of trust which is added to that number. Right? Yesterday, the press release, the company put a number, right? Today, it is able to bring that number into its financial statement and get it audited by somebody. So there is an added level of trust which is there in that number, right? And the company is also knows now what number I give. I will have to disclose it in my financial statement. So I cannot just give random numbers. I will have to be very careful as to what I give. I will have to be very, very careful, right? And MPM is an interesting thing. What if MPM? Okay, MPM is a management measure. Okay, this need not necessarily be gap compliant at all, right? It has got nothing to do with gap. The measure need not be Ind AS compliant, right? Like I said, to example of IFRS 16, right? You can adjust the profit differently, not applying IFRS 16, right? That is an MPM. So this need not be gap compliant. It is how management sees the business. The only requirement is you make the IFRS 16 adjustment and reconcile it to a P&L and disclose it in the financial statements. Okay. So I think this is the last section, which is aggregation and disaggregation. Okay. This is a new enhanced reporting which is there in the standard. It gives some criteria of how to aggregate items, how to disaggregate items. Right? So we are used to understanding presentation and disclosure. Both mean the same. That is how we are used to understanding. In Ind AS 1, presentation as well as disclosures were being used interchangeably. Right? Now the standard is presentation and disclosure. Presentation is different, disclosure is different. Right? Whatever you show in your primary financial statements. Primary financial statements are your first 4 pages, which is your balance sheet, P&L, cash flow, statement of changes in equity. Right? These 4 pages are your primary financial statements. Whatever you are showing there is a presentation. Whatever you are doing in your notes are disclosures. So standard now segregates presentation and disclosure, right? Says whatever you show in your primary financial statements always has to be aggregated and presented. The first 4 pages are only a summary, as the user needs to be able to get a full view of your financial statement just by reading those 4 pages, right? So you don't go along and disaggregate line items and smaller items and confuse the user. So make sure that there are only proper aggregated balances which are shown there, right? You use the notes, which is a more disaggregated information. It's a more disaggregated information which you give further breakups of each of those line items, right? This is what we are used to doing actually, but now the standard has given much more clarity in terms of this, at least globally, right? Companies were following very different classifications of a P&L. we are used to showing salaries and expenses as, salaries, bonus, contribution to PF, staff welfare, 4-5 line items. We are used to showing that, right? But globally, if you say financial statement, there will be only employee benefit. There will not be anything else in those financial statements, right? Plus, IFRS is a global standard, different countries following different things. So it was necessary to bring in some criteria on aggregation and disaggregation that, so that the way the financial statements are presented is meaningful and understandable to the user. Okay. So the first 4 pages will always be an aggregated presentation. The disclosure will be a disaggregated disclosure. These are some general criteria which are available in the standard. How do you aggregate or how do you disaggregate, right? You may aggregate based on nature of expense, right? You may aggregate based on function. You may aggregate based on size of the expense, right? You may aggregate based on persistence, that is whether it's a recurring expense or a non-recurring expense, right? You may not want to aggregate a non-recurring expense with a regular recurring expense. You will have to actually show that outside as a specific one-time item, right? You may aggregate based on measurement principles. Some may be measured at fair value, some may be measured at cost. So you may put together things which are measured at cost, put together things as. So these are these areas which the standard gives, but keep all these in mind. When you disclose your financial statement, decide what to aggregate and what to disaggregate, right? So I think, yeah. So these 3 broad categories is what, the standard is all about, right? So in case you have any further questions, I can take it up, or I think, we have a panel.
What we will do is, as part of the panel discussion, I have certain questions for Akshay and for ROHIT Kumar. And of course, I will also take certain questions relating to other practical areas. So accordingly, we will have the seats. Maybe I will rearrange the name boards to ensure that we are having a close discussion with each one of us. First of all, thank you, Akshay, for making this very detailed.
Thank you, sir. We will commence the panel discussion.
Could your volume increase one? And if it is possible, one more mic. First of all, thank you, Akshay, for giving us very detailed oversight of the entire standard structure and the new concepts and the practical issues. And the practical issues which we are talking about in respect of Ind AS 118. And you also mentioned that this is a professional opportunity. So I also believe that if there is a change which is happening and which confuses everyone, there is an opportunity. And Ind AS 118, because some of the questions which you posted to Akshay, I believe that we have a doubt on how we have to do on this, but the enough guidance is there. If you look at the standard, it's almost 126 pages standard, but out of that, actual standard is hardly 20 to 22 pages. Implementation guidance is almost 40 pages. That means you have been guided properly to take your judgmental calls throughout the standard. And the balance, almost like 60 or 70 pages, is the consequential changes which has been made in the other IFRS Ind AS standards like Ind AS 1.2, Ind AS 117, wherever there is a reference of Ind AS 1 comes in, there is a change. And there is also, if you look at this Ind AS 118, it is going to replace Ind AS 1. So the fundamental concept of preparation of a financial statement should be reflected somewhere, right? So a portion of that standard they have moved to Ind AS 8. When we are talking about changes in accounting policy, changes in accounting estimate, and changes in accounting errors, now they have made the change of the standard itself basis for preparation of financial statements, where they have included all these items, and accordingly, nothing new for us, but only more transparency. Somebody was mentioning this, and more clarity on understanding certain matters, and how the management wanted to present certain matters in the other than the financial statements, whatever numbers they wanted to give, also it comes as part of the discussion. That's the way in which it is there. On that basis, you may be having a lot of questions, and we have also seen a lot of practical issues in implementation of Ind AS 118. So we have structured certain questions for the panelists, for Mr. ROHIT as well as for AKSHAY, to throw certain lights on what would be the implication on implementation of this Ind AS 118. What is there in the minds of the standard setting body globally as well as in India? And what is the reason why NFRA and MCA has immediately thought that without any change, whatever we have recommended, they have also adopted. So all these things will actually make us to go with a little bit of extra knowledge and advise our clients, or if you are from industry, you will know why this is very specifically required. Okay. On that basis, I have certain questions. Since Mr. Rohit is from the public sector undertaking, I would like to have his experience in respect of how the perspective of the users of the financial statement in respect of a PSU will change after the implementation of Ind AS 118. Maybe we start with the question: what do you believe will be the most visible change users of financial statement will notice after the implementation of the proposed Ind AS 118? You can also have it connected with your experience on the PSUs as well, sir.
Thank you. So, based on this invitation, I said, what value I'll add in this conference. So I asked my people, though this will get implemented in 1/4/27 and the previous figure needs to be, 26/27, I told them, can you convert the last year balance sheet into Ind AS 118? So they gave me a few pages. So I said, can you, the most significant change is P&L. So I said, can you change the P&L and can you redraw the cash flow? So I thought when I'm speaking to you, I should look at real numbers and real changes and speak to you. So, and let me take some of the, so I'll not repeat whatever has been told on the technical side of it. Let me see some of the practical aspects. We talked about MPM. And let me take a practical example. If you have seen any oil and gas reporting, they compare, for their comparability, they use GRM, gross refining margin, dollar per barrel. Today it so happens that the auditor says, I'll not certify. We publish as part of our results because without that a reader cannot understand my profitability. Today so I'm not saying a compliance has come and I need to comply. I say need was unsatisfied, non-transparent. Now that need, will be, it will be explained in a note how it has been calculated. That numbers will be certified by the auditor. And then that will be a intra-farm comparison forever. So I'll define gross margin, I'll calculate dollar per barrel, and then I'll depict how it can be traced from my P&L. So I feel if you talk about trust, or if you tell about the usability, it is not that 5-10% improvement will happen. Though it will depend on item to item, it will depend on industry to industry, and what others can do. Items like EBITDA and all are general, everyone will get impacted by this. But there can be industry specific items which will be very, very significant when we try to implement them. And then my outcome when my team, recreated my March 25 financial into this format, it's not very difficult, And we all know when last time we, did this classification, Ind AS 1 or Ind AS 1. So we broke our income into other operating income, other non-operating income. We brought our expenses into operating expenses also into divided. So I tried to find them out. Are any more complication exists in classification? I found no, the rules were pretty straight. Only few nuances has to be understood. And if you read it once or twice, these are pretty simple. And then, another reflection that came to my mind, this cash flow statement is there in our financial statement for quite long. But even the highest professional was not making much use of it. Now, when your P&L categorization is in link to your asset, cash flow and asset categorization. So, asset categorization you can do, P&L is now forced, when cash flows are coming. So you know where money is coming in what terms and how you are doing it. So I feel even on the visibility, understanding, making your own assessment about what is the worth of this company, what the, how the income, the cash flows are likely presently, what are affecting it, what is the future, I'll not call projection, but direction or understanding, it will facilitate a lot. So that way I feel, though the efforts are little, there is some dedicated efforts are required, but I think the outcome to the company, to the investor, to the other stakeholders who look at your financial statement for different purposes, the utilities will be much more commensurate than the effort that has to be made. So I'll rest here with respect to your first question.
So it's a nice way of looking into that. That's the reason why we selected you as part of the panelist. When you said that you started working on the numbers and how it will reflect, if I adopt Ind AS 118, maybe a case study for us also to understand further what are the challenges which you have faced and what are the judgment calls which you have taken. So you also mentioned that it requires a little bit of effort, but the outcome or the results arising out of that is really going to increase the confidence of the investors, and the numbers which the management discloses is also going to be audited along with the regular audit process. And naturally, there is a possibility of additional income coming to the professionals as well. And one comment which I remember looking at, all these things are going to be done by the chartered accountant and not the CFO level. For your information, majority of this is applicable only to Ind AS companies, and Ind AS companies will be well established in the financial reporting framework, and the team will be already preparing the financial statement. So to that extent, audit will be part of our work and not preparation of the financial statement. That's what my strong belief. In fact, I was just looking at what would be my addition to this particular question, if at all we have to look at. Is there any significant enhancement in the financial statement presentation and disclosure has happened because of the proposed adoption of Ind AS 118? I actually found that there are 4 layered structure in which you can actually look into. One is the profit and loss account. AKSHAY has done in a detailed manner, so I'm not going into that. A structured profit and loss account, and the way in which we have learned from the other panelist, Mr. ROHIT, that the profit and loss account will communicate to you now a meaningful information rather than just a number. Like EBITDA, profit before tax, etc., may not be the actual number which will give the real position. When even the other income has been split and it has been shifted to the various activities, the more meaningful understanding of whether the operating activity really gives the profitability or your investing activity gives the profitability by which you are covering up your operating losses will be very, very clearly seen. For those who are feeling that this requirements are scary, I just wanted to tell you a very simple thing. More or less, like a segmental reporting, you are going to split this activity. So it is a little bit of extended work which we are supposed to guide the client and also to do our training our audit team, and on that basis we can actually do that exercise. And again, when we were talking about the defined subtotals of operating profits And when we were talking about your profit or loss before financing and the taxes, is also going to give us more idea. In fact, if you see a T-column balance sheet, profit and loss account of a non-corporate entity, and you know what is the gross profit and how it changes based on that activity, and how your net profit moves because of your gross profit margin has increased or decreased, how you have effectively controlled. That is not actually available in a financial statement of an Ind AS company as of now. Under Ind AS 1, now the opportunity comes in. So instead of we just call gross profit, we are going for an operating profit. That is an additional enhancement which helps to understand the financial statement in a better manner. And when we were talking about the next criteria, I wanted to ask Akshay. We saw Akshay was mentioning that the items in the profit and loss account or statement of profit and loss will be either given in nature of expenses model or functional model or in hybrid model. In this one specifically restricted only to the nature of expenses model. Now we have opened up to say that you can go for a functional classification or you can even go for a hybrid model. The immediate question which comes to our mind is that the comparability of a financial statement gets impacted if one industry, one company in the similar industry is preparing and presenting the financial statement on functional classification. Another company is giving on nature of expenses model. Another company is using hybrid model. How this is actually going to make us to make a comparative understanding of how the company has actually performed. Okay. So what should be the parameters to decide on nature of expenses model, or functional classification model, or hybrid model? If there are any guidances you can share from your experience and your research which you have done so far.
Sure. First thing, nature function is not a choice. I mentioned that is, we have to be very clear. It's not a choice which is available to every company that you decide whether I'm going to do a nature or there is a function, right? The guidance provides clear factors that you should use to decide which form of P&L actually is best depicting your performance to the reader or the user of those financial statements, right? And the best way I as a reader would like to see the financial is how the CEO of that company sees that financial statement, right? How the CEO really sees his business. He knows the business better than anybody else. Like sir was mentioning, right? There are measures which he sees which are not there in the financial statements, right? We may be showing a nature-wise P&L traditionally, but that CEO is not bothered about that nature-wise P&L. He only wants to see his functional P&L, right? So the first filter would always be how that CEO or the management really sees the business, right? That would help in determining whether I have to do a nature or a function. Second important parameter which sir you mentioned in terms of comparability, right? So how the CEO sees is an internal view, right? There is also an external view which needs to be factored. How the industry really shows your business, right? If you are in a hospital business today, right? Are your peer hospital companies doing a nature-wise classification or are they doing a functional-wise classification, right? If everybody is doing a functional-wise classification, there is something wrong in your assessment, right? It should never have been a nature-wise classification, right? So obviously that is one of the factors which is a very important factor, that how really peers are showing. So internal view plus external view, both put together, we take a conscious choice whether I want to do a nature or a function.
That means it is not just an accounting policy choice or an option given to you. I go for option A or option B or option C. As Akshay has very clearly mentioned, you have to decide why you are selecting nature of expenses based on the parameters. So in other words, how the industry is looked by the external analyst could be, or what is the industry practices, etc., whatever is listed out, is the driver behind selection of a particular approach. Again, the guidance, implementation guidance, which is included in the standard, gives a very detailed guidance on these parameters. And the crux of the story is that it is not just an accounting policy choice. whatever option you are selecting should be based on reasoning. And the reason is based on the parameters which Akshay has mentioned. Thank you, Akshay, for making that clarity. Otherwise, we will always think that it is like in IAS 1, it is an accounting policy choice and we can choose anything. And to that extent, the comparability will get impacted. And another thing also which I believe that the comparability may not get impacted because of your other parameters like your activity-based presentation of operating profit and then investing activity and then your financing activity. Then you can make out whether whatever classification they are doing, the net profit compared to the total revenue, is it reasonable? That also can be actually assessed, and to that extent the comparability can also be maintained. So that is what very interesting point. And when we look into the detailed presentation Akshay has made on making judgment, pulling out the numbers, classifying the numbers into various categories, and then arriving at a reconciliation, etc., it requires a lot of calculation, a lot of data to be mined and data to be crunched. So if we do all these things, it may not be possible for an industry or maybe a company which is having a size of CPCL and IOL, which has been handled by ROHIT ji. And accordingly, depending on the system to deliver all this information is the critical key. What, in your opinion, the various system changes or preparedness to make the changes to take this information for reporting under 118 is required, sir?
So let me start with some of the basics. Chart of accounts. Unless you have a chart of account, you can't do anything. And again, when I recall my middle level working, we used to prepare even for system. Today, everything is on system, on ERP or some other system. You know, you'll prepare a chart of account for your accounts, the way it can come in your, companies that format. And parallelly, you will create another chart of account for your MIS, which will go to management because you will not be drawing. You need both of them parallelly. Rather, the MIS you need first, before finalizing the accounts and getting it signed off from your auditor. I think this dilemma, where, MIS is required first and separate efforts are required, I think that will require some effort and then one of the boons that can come is you can integrate. Can you integrate? Now that because these kind of integration and analysis can be part of your financial, can you work in tandem with both chart of account and you can integrate? That's an opportunity. But yes, some fresh mind has to be applied and effort has to be made redesigning or fine-tuning your chart of accounts, be it an integrated one or a financial one. That comes foremost to my mind. Second, I feel even though we have been doing classification into operating, financing, investing, and other activities, I think now that it is moving to your PNL, and even though major changes doesn't happen, even the way we saw, one will feel my finance expenses will not change. But once you take out the net interest cost in your actuarial, then to some extent it will change. So, so like someone says a reflection, you have to see to some of these items in a very nicer, softer way and look at minor differences. So some effort has to go into classification and it will depend on each business, how you are doing it. So everyone has to reflect on that classification. MPM again, is a new concept which can be compulsion based on the industry, but people, who either are doing business in different segments or are doing unique businesses, I feel MPM is another area which they have to little reflect back. And again, it may be evolving area. You may start with one, you may start with MPM in a particular way. And because the standard gives you that flexibility, no rigidity, that you can evolve, you can add, you can delete, you can modify the way you present. I think MPM will evolve over the period of time with 118. And that will add a lot of value. But there again, some thoughtfulness would be required. And finally, because everything has to be audited, I feel now whatever audit trail you had for your financial, you have to build in some more audit trail in your system so that those can be easily verified and certified. So those are the few 3-4 broader areas I find. But I think this should be interesting because you will find the immediate results out of all these efforts.
Actually, this is a very good practical insight. In fact, when I was going through the standard, the first best practices which I thought was also started with realigning the chart of accounts. So information to be drawn from the IT. So naturally, you have to start with what you wanted as an output. You must have an input. So that's the way in which I thought exactly that is also coming from the veteran in the field. Interestingly, what we have seen in respect of the IT changes, etc., and the information which we are reclassifying, etc. But I must tell you that it is like an effort. That's the reason why he has mentioned that it's a professional opportunity. When the first time adoption of Ind AS has happened, every person who has have an expertise in Ind AS had an opportunity of getting an assignment of helping transition to Ind AS. Now, this 2027, April onwards, for accounting period commencing on or after 2027, with a comparative for 31/3/2027, naturally, some sort of preparedness has to happen within the industry. And some sort of guidance they will look at, because the institute is said to come out with, because it's only an exposure draft, educational material, frequently asked question, etc., has to come out. So when all these things are going to be in place, maybe we will be losing the actual, the benefit of being the front runner. So if we start doing that exercise right from beginning, that could be a possible professional opportunity of going and approaching your client and what type of help or guidance is required for restating your financial statement. It's not just 2028 financial statement, but 2027 financial statement as a comparative should also be restated. So that is one area. And one good point which I have taken, I never even thought about it, is that NPM is evolving is the word we have used. But the problem which I have seen is that the moment you are doing an NPM in the current period and you are changing the basis of the NPM in the next period, they are asking you to restate the comparatives also according to the new NPM. So there will be a continuous professional opportunity available, because NPM will be evaluated every period of time, and guidance could also be provided to the clients at a point in time. So that is good practical insights on that. And you have mentioned during the course of your presentation on aggregation and disaggregation, and you have made it very clearly that the disaggregation is actually going to the notes and aggregation is actually in respect of the financial statement. Can you make more specific enlightenment on this aspect, especially aggregation relating to the items to be presented in the financial statements? More or less, we are having in Ind AS 1 also, but this goes a specific enhancement under Ind AS 118. So I would like to hear from AKSHAY on what are the other specific pointers we have to look at when we go for an aggregation.
So when I read the standard for the first time in terms of aggregation, disaggregation, there seemed to be a lot of English around aggregation. These are the facts you understand. And I was wondering what is the relevance of this aggregation and disaggregation, right? Today our financial statements are very beautifully presented, right? And then when I thought back, I realized when I actually look at global IFRS financials, right, they are not so similar, right? Everybody follows different totals, different. Somebody shows gross profit, somebody shows operating profit, right? Somebody does not even show employee expenses in their P&L account, right? It is sitting inside other expenses. There were numerous ways in which financial statements were presented, right? And that's why actually IFRS has got this aggregation and disaggregation to bring in more level of comparability and show that, information doesn't get obscure and there is a balance of information. There is always a balance. There is neither too much information, there is not too less information. The first 4 pages will always have to be a proper executive balanced summary, right? And there should not be details which is sitting inside those 4 pages, which will actually lose the meaning of those 4 pages. You cannot provide extra details there, right? And in India, right, to our advantage, we had Schedule 3, right, which actually already did a lot of this job of aggregation and disaggregation. Right?
If you see a Schedule 3, it will go and break up data more than 6 months, less than 6 months, right? They have taken care of collection as to there is an aggregation or disaggregation criteria based on collection. They have told instruments in FETPL have to be classified together, right? Current, non-current classification is already there, right? Employee expenses are already segregated into, say, a staff welfare, into what is a contribution. Based on the nature, they have been segregated. So Schedule 3 actually inherently did an aggregation disaggregation which we never realized, right? And today the standard is actually telling us you have to do all this, right? Though Schedule 3 has to still, has to get aligned to this Ind AS. But if nothing changes in Schedule 3, I hope Schedule 3 doesn't say that, we are not giving you any breakups, you please apply aggregation and disaggregation criteria and identify what are the breakups, right? So Schedule 3 in that sense made our job already easier.
Okay. Sir, again, I am coming back to you because the large volume of data and information will be processed by you in preparing the financial statement of PSU. So if you are able to understand from you how you manage those information, you will be easily apply it for the other entities also. The next question for you is, you have multiple performance matrices to different stakeholders. For example, for ministers who are reporting differently, regulators who are reporting differently, for investors who have a different thing. How do you see this MTM disclosures can be aligned without any conflict with these expectations by the various stakeholders? Because as rightly pointed out by AKSHAY, too much of information will always lead into confusion. And at the same time, I wanted to put something under the carpet by giving some disclosure. So any material information which I should understand should be known to me. At the same time, when you have to have different stakeholders, each person is requiring different disclosures, how the NPM can be practically used to take care of or aligning the expectations of various stakeholders.
Yes. So I think Akshay also covered in his presentation that some of the mandatory statutory requirement all cannot be a sole basis for NPM. But then in my discussion, we checked that example of GRM, gross refining margin, which we said was so key that even if it is uncertified, I used to publish voluntarily. So if I see the genesis, what is the genesis? Genesis is we saw irrespective of person, this information was so key for, period comparison, for firm comparison, for analysis, for checking out the profitability potential. So it was not ticking one box, it was ticking multiple boxes. So mandatorily I did it. So I think one of the criteria would be, what are these kind of information which irrespective of regulation makes sense to others, and that can be set as a industry benchmark, or the classification and the calculations are not subjective, and those will be the first point. Second, but I feel everything that is required by different regulator or stakeholders, or I am compelled, can't be put on the financial statement, because that will be like overburdening and excessive information. I think some of them still needs to be given separately. But one thing that comes out and which we touched upon is that this MPM will evolve. See, you go and take a medicine when the pain is unbearable, correct? But when out of a process you start getting utility, then you start reflecting and thinking, So I feel this MPM, based on good practices and others, will be another area where now management will be aligned to have the single source of truth. On those important metrics and important items, they will like to have a single source of truth, which is part of your financial statement and which is audited, which can, and then I was thinking another dimension. Some MPS will come based on industry specific requirement. Akshay mentioned EBITDA and all. These are very common parlance which can be, deducted from the financial. But there could be other, non-sectoral comparison MFM can come, which can be compared, across sector. Because today when the investor looks at, he not only picks something in a particular industry, he also tries to compare across industries. And even when we look back our studies, we always have, tried to find out make or buy decision. Correct. So when I say from a business model,
I may like to know, based on the financial, whether it's a make or buy a business model company or own capital versus, debt capital kind of a company. So I know the cost of capital, the deployment, the return. So maybe going forward, these kind of metrics will get developed where across sector, these MFN will become very, very critical, and may go a long way in investor protection, general awareness to investor, and to bring in transparency in the normal trade and commerce.
Perfectly correct, sir. In fact, that is the reason why I have specifically asked you to share your experience. When we were looking at the best practices as far as the MPM is concerned, both of them have given a very elaborate guidance when is excessive is not required. So at the same time, the simple three rules which we can talk about is limit the MPMs to metrics genuinely used internally. For what is your MS purposes you are using in MPM, that you wanted to reflect, because that is the way in which you manage your business, that is the way in which you measure your performance, that you talk to the others, to the stakeholders. This is how I am developing my business. This is the way in which my business is growing. And these are the performance metrics which I am applying. So that constantly develops and constantly grows. So that is one thing internally what you are using. Preferably that can be considered as part of NPM. That's one important rule or maybe important guidance. The second is Akshay has point blankly said avoid excessive information or excessive adjustments, because too much of information will not actually going to help anybody. And again, whenever we are doing something, we also look at the investor mindset. Even in the analyst calls and other things, we are trying to understand, apart from the financial statement, what are the expectations of the various investment investors and how they are looking our financials, including the other perspectives like credit rating agency, etc. If we are aligned with that number, it's possible, but only practical issue which we are having is that we use the word explanation of segmental reporting for this MPM and other category also, is because whenever you are giving an MPM numbers, you are supposed to reconcile with the line item in the financial statement as well. So the credibility of the MPM disclosure goes up because of that particular reconciliation. Efforts are required to do the calculation, reconciliation, aligning with the financial statement line item. If we keep these three in our mind, MPM will not be an excessive disclosure, or it will not obscure the information which the user wanted to understand. Having looked at the structure of the financial statement, etc., from Akshay, I wanted to check that from the audit and assurance perspective, coming to the profession now, because financial statement might have been prepared and presented, but how we will do the audit? Does the new presentation structure help reduce ambiguity in the performance reporting, or does it create new areas of judgment and potential risk?
So in today's world of AI, right? If you say something is judgment, I am very happy, right? Otherwise, ChatGPT could have prepared our financial statements too, right? So thankfully, standard leaves enough scope for judgment, right? So judgment is not really bad always, right? A well thought about financials and presentation is much better than a straitjacket approach, where, irrespective of how you do your business, how you run your business, right? You are presenting the financials in a same nature way, right? Like traditionally, irrespective of how I saw my business, I always used to show a nature-wise P&L. That was not really reflective of my business. That really didn't show the users any meaning, right? So well thought out judgment as to, really is the financial statements today reflecting my business? That's how I want the users to read my business? No, I do not want them to read it that way, right? So judgment is very important. A well thought out judgment is very, very good in that sense, right? And the standard gives enough guidance to help you make that judgment. The standard has not just left it to your judgment, right? It has told you that these are the 4 factors you look at, these are the 5 factors, these peers you look at for an M2M. So there is enough guidance which is available. And like we say, MPM or any of this today, it is going to evolve. Right? There are hardly any companies today globally who have adopted it. There are hardly 4 or 5 which we can count who have done a voluntary adoption of this standard today in the IFRS world. Right? So everything is going to evolve. I'm sure IASB is going to come up with more guidance. There is going to be ITFG clarifications. When we actually, right, Sir was able to do it in 2 days in terms of getting this done. But I'm sure when you actually implement it, try to get it audited, you will realize there are a lot of nuances which you have missed, and there will be a lot of new questions which the standard doesn't have answer to today. It will really not have the answer, right? So more and more guidance is also going to evolve and help you make a very informed judgment. Right? And so that informed judgment will also make sure that your users get that benefit. In terms of risks, risks are always going to be there as an auditor. An auditor can never avoid risk, right? That is a part of the profession. That is really a part of the profession. In every accounting standard, there are elements of judgment, there are elements of estimate, which risk is always going to be there, right? Now, how an auditor and a management may avoid that risk is, right, proactive interaction about these judgments. Today, we know that the standard has come. There are judgments and estimates which I have to make as a management today, right? I proactively start interacting with my auditor, right? That these are the areas of judgment which I'm doing. This is how I am looking at this, right? I am thinking of next year presenting my financial statement in function. Are you in agreement with it? So that proactive discussion between the auditor as well as the auditee helps the auditee makes a better informed judgment, also helps the auditor cover his risks and does not have a last minute surprise, right? One more thing in terms of risk, which Mr. Sir mentioned, is an audit trail, right? Audit trail, right? All these judgments today which you are making, right? An audit trail is very, very important. An auditor is always going to ask you the trail to cover his risk. It should not be in a CEO's mind. None of these needs to be in a CEO's mind. Today, in a private company or a promoter company, many of these are going to be in a CEO's mind, right? Lot of listed companies in India are also promoter-based companies, where still things are there in the CEO's mind. These have to, now you have to actually document. How did you decide this is an MPM, right? You should have a policy around MPM. If you see any SEC registrant, there will be publicly available policies on their non-GAAP measures. What really are their non-GAAP measures? How do they define those non-GAAP measures, right? So you'll have to define, like you are used to SOPs on other processes, there will be an SOP which you'll have to set around M2M. How am I going to decide what is my M2M? How am I going to set up a communication channel between my investor relationship team and my team? What are going to be the SOPs? How am I going to decide who are my peers, right? Who are my peers? There may be a lot of companies in the entire world, right? Who are my going to peers, whom I'm going to pick for my M2M? How am I going to measure this M2M? Which is going to be a measure, right? Today, listed companies, there is a lot of profit pressure, right? Sometimes an company is looking for a small thread or a leeway which is available in the standard to show the profit in a particular way, right? Sometimes it is there. That is how sometimes the management may see it, right? An MPM may be used sometimes that, today my profit is low. Why not I show an MPM? Why not I adjust profit or loss on sale of fixed assets and show an adjusted profit? Right? Why not I do that? Why not I adjust some items, right? So these things can start coming into the picture. That's where the auditor-auditee relationship and upfront communication is important, right? Where you have a process that these are the 5 items only, I believe, which I am going to adjust in my MPM. If tomorrow I am going to adjust something else, there has to be a proper rationale. Why am I going to do that adjustment? And on a future ongoing basis, that is how it's going to be. It's not on quarter I am going to change, right? So those process, policies and procedures will have to set in place to cover those kind of risks.
Good point. What I gather from the detailed explanation which AKSHAY has given, the first point is the entire standard is not rule-based. So nowhere it is talking about this is what you are supposed to follow. What it guides throughout the standard is, if you are taking a position, what is the judgment involved in that, and what is the rationale behind the judgment? That should be known to the auditor, and the auditor will eventually review that whether the rationale is correct or not correct. And similarly, it has to be explained to the user of the financial statements as well, according to Ind AS 118. And user will also be well educated on why the rationale has been done, whether it is a reasonable rationale or not. And because of the rationale and guidances available on making judgments on matters, even for the classification of your operating activity, investing activity, financial activity, there is no rule. It is only says that which is the correct income category and what is the expenditure relating to that particular activity, then you classify that. Only if you are not able to relate it directly to that particular activity, go to the residual category of operating activity. When this type of guidance is also available throughout the standard, automatically the audit risk will get reduced. That's what my take from what Akshay has mentioned. And I have, since you yourself as getting to trouble, sir, because you mentioned that when I asked the first question, you have shown two profit and loss account. One you are already prepared for a financial statement and another is according to Ind AS 118. So you will be the right person to answer this particular question. What are the step-by-step process in implementation of Ind AS 118 in an organization? Your practical experience will help us a lot, and that's the reason why I'm putting this question to you.
I think either on a lighter side or on a serious note, the only answer is, I think once the standards are available, whatever financial statement we feel is more appropriate to take and see, at least on a broad basis, without going into nitty-gritties, what are the reclassification happening, what things are moving from where to where. So at least I will know what kind of efforts are required, what kind of directional things are required, where judgments are required and where not much judgments are required. So I feel the best thing is to start early, that we say in any respect, you have to pick up something of your liking, something that you understand, maybe your financial, maybe some other financial, where we understand the business, we understand, or a good detailed financial statement is available of any company. I feel that's the first point. But as we said, if you want to implement in a detail, if you want to be a consultant and you want to help someone, then the efforts are a little more. Then you have to go understand, prepare a chart of account, look into your systems where it is coming. You have to analyze few years of MIS and see what are the metrics. Some of the compelled thing will be known to you, but the more useful thing has to be found out. Like even Akshay said, he said, from the broad, I will find there are 2 items will move or 5 items that will move. But when you go into some of these items, maybe more nuances will come. So for a consultant, the efforts will be little gradual, efforts will be little detailed. But I think there is no shortcut. You have to put your hand into that pot, and then that is how you have to create that.
I will just supplement this and then I will take your question, sir. Basically, when I was looking for and I was giving a parallel to India's transition implementation as well, I was, the moment he has shown that number, it fascinated me and I was immediately going to that direction. Even in India's 101 reconciliation of equity, reconciliation of profit, I used to say that this is like your bank reconciliation statement. So, if we connect what we know better and use that tactics for aligning with what is the new requirement, it will be easier to do it. So, I also felt that from SIR's point of view, I got that the various step-by-step process for implementation could be performance business model based classification assessment you can do and how you wanted to do, including your classification of what is operating activity, investing activity, or your this thing, along with the lines of guidance given in Ind AS 118. Redesign the chart of accounts, sir has already mentioned, including ERP mapping or SAP mapping, so that information can be straight away drawn from that particular thing. What could be the potential NPM? Early, you can identify them and establish a governance over how that information should be given. Could be the third one which you can talk about. Training is very, very important. Then only people will understand what type of information I have to give, and training both in the industry perspective as well as from the professionals perspective is very, very important. And of course, whenever we do anything, we will not go straight away to what I should say, the production environment. We will not go and make any changes. We normally do a dry run. Yeah, I still remember that for one particular Ind AS transition, I have prepared 14 different financial statements and given to the management with various reasons why they have to adopt on this 14. But of course, as a consultant, I know very well that the first one which I have decided will be picked up. But to show that I have done so much of effort, we have actually put 14. But 14 are with relevant changes. So you have to do a dry run and ensure that the stakeholders' communication is also being done. So with that, I come to the final question, which we will have. Before that, sir, please, your question, sir. Ind AS 1 and Ind AS 118.
My existing statements are MAT. Practically, I have moved out of MAT. I have chosen the new tax regime.
Sir, since it's a tax question, I will pitch in here. Because your MAT computation is governed by Section 114 JB, your book profit remains to be profit before tax. That remains the same. Because it's only a presentation and disclosure in respect of this particular Ind AS 118. It is not a measurement standard. It is only a presentation how it has to be there. No, whatever you are shifting, the ultimate net profit remains the same. It is not going to change anyway. Instead of showing as part of my operating activity, maybe I will show as part of investing activity. That's all. So accordingly, your book profit will not undergo any change. And accordingly, in adjustment also, if you see 115 JB, when they have considered for the Ind AS companies, they have specifically come out with some two different adjustment. One is relating to transition adjustment and another is relating to the regular adjustment which is going on in every year. And transitional adjustment, they have given a period of time within which you have to adjust. And for the other items, they have said that if it is a notional item, you need not adjust like that. They have explicitly removed it. Accordingly, here also, we expect that that type of guidance will be coming in. Then it is there, sir. Naturally, it will be there because the computation of taxable income is different perspective and accounting profit is different perspective. That is the reason we have Ind AS 12 for deferred tax accounting. So in 115 JB also, how you compute the book profit for the purposes of 115 JB is defined by the section. In that item, for example, when they looked into fair value of investments which I am doing, it increases the book profit. So in a normal scenario, because it's part of the book profit, I should pay tax on that. They have understood that this is a notional income. This will be covered by means of my capital gains when I am actually disposing it. They remove it. Accordingly, if there are some issues which will be coming in, definitely that will be taken care as part of an amendment. That's the way in which the representation will come in. So I believe that it will not have any impact in 115 GB MAT adjustment also, because the ultimate profit will remain the same. Okay. Any other questions which anybody? Yeah, Akshay.
Three things that, so one, since we are used to preparing a financial statement on a nature basis, we hardly, as auditors, we hardly take and view the MIS statements. Now, since it's moving towards a functional basis, we may have to preempt the management that such a disclosure is coming and take the view of the MIS presentations well in advance. And second, practical challenge that I see is we are okay as long as the cost is booked under the relevant account. Now we have to look at the cost center hygiene, which will play an important role in cost classification. So revenue is largely taken care of in the present system. And third is one request to the institute is like how Big Four present and illustrative financial statements. This being a total revamp of how we will be presenting the P&L. If an illustrative financial statement is presented and made available by Board of Accounting Standard Board, it will.
Okay, the last question I will take it up because that is my last question. Okay, was the panel they have given to me as panelist, but coming to the other aspects which you have talked about, even now, as per SA 700, when we were giving the audit report, we are having a specific paragraph on information other than financial information. Have you looked into, because there is one obligation on the part of the auditors, if some information is added but not audited by you, but whether it has any relevance to the presentation or misleading, either you say, I have not done anything. So you wash off your hands. Now, as you rightly pointed out, you cannot wash off your hands and you have to actually look into the rationale behind it. My personal experience with well-structured companies who will be doing all these activities under Ind AS is that they have a proper accounting system or financial reporting system, and they will be able to pull out the MIS in such a manner whatever cost center you are talking about will be already established. Maybe it requires only a little bit of fine-tuning. As an auditor, when I am doing the checking, I should go with an open mind that management knows better than me about the business. If we assume that we know the business better by doing an audit for only 1 month and say that 360 days somebody is working for, let's say, 30 years and they don't have any knowledge, that is a wrong mindset. But unfortunately, majority of the times when we go and do the audit, we go with that mindset. With this, I think that the correct choice will be, you trust the client, but the tagline always verify. Verify and document. What is the rationale, how they have done the allocation, whether the allocation is in accordance with the various categories which are given. MPM, when we are talking about whether the MPM numbers which they have arrived at is acceptable, what is the industry practice, because everything is not very based. It is very clearly guided and it's not also an accounting policy choice. And to that extent, I think that the audit role may be a little increase in the first year. Similar to that, management role will also increase because they have to set up every ball rolling. So only at that point in time, we have to, Akshay has rightly used that word, we have to work along with the client. Then only it is possible to do that. So the open mindset we should also have on this. Coming to your last question, one of the questions which I was having in my mind, and of course the ASB has also asked me, what specific steps should ICAI take proactively to ensure smooth implementation of Ind AS for Indian companies? So it is not just only an illustrative financial statement. They have talked about what are the proactive steps. When I was actually looking into what are the proactive steps, first of all, I saw like the implementation challenge which we were talking about. We should have in classification of operating, investing or financial as well as MPM, the guidance is industry practices as well. And accordingly, if we wanted to ensure comparability of the financial statement, taking from the clue both AKSHAY and ROHIT has given, we must have industry specific guidance to be issued by the institute. It is not just an implementation guidance, or it is not just an educational material. They should come out with industry specific guidance, which we have to look into that. And this is only the initial start point today we have in SIRC. Training is required, and training is a continuous process. Learning itself is a continuous process. So structured learning for CFOs is required, auditors required, not stopping at that level, even to the audit committees and the board is required. So they should understand the number better. Because even if I change the format of the financial statement, I may be spending more time, especially the CFO and Director of Finance will spend more time to make the Board of Directors understood why there is a small change, especially in PSU it happens. Even if you are removing one particular disclosure which was there in the This time you have removed because it's not applicable, or you added something to explain it further. You have to make a very big note while you are including that type of information. So training the board and audit committees is also required, apart from CFOs. Naturally, when you are talking about auditors, audit team is very, very important people who have to be trained, because majority of the time in one of the firm in which I was working, we have an induction program which is called Go Audit. So that means it's an induction program. First, when somebody comes in the audit department, we tell him go audit. But normally what happens is we ask him go audit. And then only the instructions are being given or guidance has been given. That should not happen. We should always actually give them the proper guidance for our entire team, so that they will be able to ask relevant questions to the client, and they will not bother the client too much without their understanding. That is very important. And when you are talking about the transition, I believe that you have to think about your comparative information also. So transition period positioning, transition period, hand-holding of the client is also required. The consultants will come into the picture at the point in time where it's a complex scenario where management and the auditors alone cannot do it. Expert people should also come into the picture. And of course, this is the last message which I wanted to leave, because I was impressed by the words it's evolving. So this Ind AS 118 is also evolving. So accordingly, what is the changes which is happening, or emerging changes which is happening in understanding our classification of the items in the P&L or MPF, etc. We have to continuously watch what is happening in the industry, what is happening globally, and how we can take that as a best practice for implementation in our industry is very, very important. These are all the things which I gather from the two expert panelists they are having. In fact, I was very happy that I was one of the panelists, but the chairman of ASB has made me as the moderator also. So I was made to play two roles. So I restricted my questions to a greater extent for a simple reason. A lot of information has already been shared by the two expert panelists. And thank you very much, Akshay. Thank you, sir, Rohit sir, for doing this. And thank you for each one of you for very seriously listening and taking the inputs which we are trying to offer. And the best takeaway is the way in which we can handhold our entire team to do the transition and ensure that the implementation is also smooth. With that, I hand over the session to the moderator of the entire session.
Thank you, sir. Thank you for all the panel speakers and the members for making a seminar a meaningful and enriching experience. The session has provided different perspectives and valuable takeaways on Ind AS 118 presentations and disclosures. We appreciate the efforts everyone involved delivering a seminar that encouraged learning, interaction, and professional growth. Thank you. Thank you. With this, we close the seminar.